right, guys, I got a doozy for you here. This is a brand new financial model. It's in the freemium space. So, freemium just means you have some kind of monthly active users or monthly visitors, and from those visitors, you convert them to a free service for which you display ads and collect ad revenue. And then you also try to upsell those users in the free pool to some kind of paid monthly service. And you have both an ad revenue and a monthly, recurring revenue. I've never done this specific model. I've done some that are close to it, like the mobile app slash website recurring revenue. But the difference there is that model does not have logistics to do ad revenue, or that's not built in, and it has been built in here. So this model is going to be super flexible. Again, every time I do a new full-on financial model, I try to incorporate everything I've learned in the past, and as I've talked to clients over the past years, just trying to make the best, best and most useful kind of pro forma type financial forecast for um, your startup. Okay, so what we're going to do, I'll go through each tab, explain what's going on there, and then kind of show the high level summary. So to start off, we are actually going to start off on the fourth tab over. And in general, the high level view of how this works is everything that you can edit as a user of the template is going to be in light yellow, and 99% of the cells that will have light yellow cells in them are these yellow assumption tabs. Now there are some assumptions like depreciation that's in the monthly pro forma, and then there's some exit value stuff in the executive summary, but we'll get to that. So okay, so we're gonna start a freemium business. So where do we go first? Well, let's look at the revenue assumptions. So up here we just have the start year. So this is just to set the setting of the model. So it's gonna here you'd put the first day of the first year. So the model will go out 60 months from that, and then you're gonna set the start months that you plan on traffic happening. So you might be starting maybe halfway through the year. So let's say traffic's gonna start in March. And how much traffic do you estimate? We're just putting 150,000 here. This is arbitrary right now. It's just to as a filler so I can demonstrate the logic. So we've got 150,000 monthly, you know, monthly people coming to whatever it is that you're selling. It could be to the website, whatever gets people to come and then sign up for a free account. So this changes each year by this percentage. So if you put 25% here, it's saying, okay, in year one, your average monthly, your average monthly traffic was 150,000. In year two, it's 187. In year three, it goes up by whatever this percentage is. I just did hard 1 year cliffs. It's not because you're not going to really know. You just want to try to predict some kind of something that you feel is reasonable for what you're going to think you'll be able to have in traffic. Next is the month your free service starts. So again, this might be, let's say you plan on traffic starting in March. You actually don't want to launch the free service. You could put it in March as well, but let's say we were actually not ready till May, so we'll have that offset a little bit. So nice flexibility there. Then we've got expected monthly visitors converted to free service by year. So this is saying in year one, you're going to convert 0.5% of the monthly traffic to your free pool and whatever that is. So it might be, converting them to, I don't know, it could be some kind of content where they can view content and all they have to do is have an account. But then they're going to be subject to ads. It could be like, this is similar to a mobile app where you have people playing an app for free, but then they have to pay, or they don't have to pay, but they have to view ads. Um, so there's that percentage of your traffic, and that's where it's all going to funnel down. So we've got that, and then year two, three, four, and five. we can change that percentage if you think you're going to improve your conversions or you're wanting to. You can see how that plays out um, across 5 years and how it affects everything. We've also got average monthly impressions per free user. So this is obviously for your ad revenue. Normally it's counted as cost per 1,000 impressions. So we're trying to predict how many impressions we think the user will contribute or produce in a month. This is going to vary based on what kind of content it is and just how often they are going to be exposed to um, just viewing different things. Um, so it could be a lot more, it could be a lot less. It just depends. Then we've got the amount of ad revenue you're going to make per 1,000 impressions, and that can obviously change over time as well. I was just testing some things here. Put this back to 1.5. Now, when you do get this model, if you do go through and work through it, you're going to want to zero everything out in yellow and just start from scratch, so you um, don't have any of my loose assumptions in here. Uh, Next up is the monthly churn of the free pool. So this is saying, of your free user pool, maybe some people close their account. Just like, I don't know if you had a Twitter and you decided to close your account. Well, you're no longer going to be exposed to ads if you don't have an account. So this is the way to account for that. And this is a monthly amount that you're going to churn, and it can change each year of the forecast. So again, this is pretty straightforward. Um, Assumptions. Let's go to the monthly paid service. So this is going to say when you plan on offering the paid service. So this might be not even till a little bit after this one. So we've got May here. Let's say July you're going to launch the paid, and your expected monthly conversion from the free pool to paid. So this is how of the total monthly users every month that are in this free pool, how much do you think are going to leave the free service and go to the paid? And the paid service could simply be, you're going to turn the ads off for them, or they could actually be paying for extra services, or uh, there's a million different scenarios. But this is just a percentage of those people that move from free, so they're no longer creating ad revenue for you, and instead they're paying you some kind of a monthly subscription. So there's that percentage. It changes by year, and you could make it go up. Obviously, you'd want it to be going up if you're more profitable with paid subscribers, which is likely going to be better than ad revenue. Uh, Next, we have the price paid, um, price for the paid service. So whatever you're going to charge these people per month, and you could obviously raise that over time as well. It's likely going to be some lower number unless whatever they're signing up for is more expensive and costs more to provide. And in that case, you're probably going to have lower conversions. But the point is, this logic all exists so you can assert your projections accordingly. Then we've got a churn of the paid pool to free. So this is if you have people who are in the paid pool but then churn up to free. So they close their paid account, and that, like, if they don't mind seeing ads again, if that's the case, then they just stop paying, but then they move into the free pool, so they're still generating ad revenue for you. Then there's churn. People just close their accounts of the paid subscribers, that percentage per month. And then there's the percentage of traffic directly to paid service. So this is of this like 150,000 a month, how much of that percent goes directly to paid. So that covers pretty much all the basis for revenue generation, the timing of it, and the logic, and it really gives you a nice way to. Uh, it's dynamic, but it's also high level enough. Um, so it can be used by a wide variety of freemium startups. Next is expense assumption. So here I've just tried to be really standard. I've got a section for G&A, and this just is a monthly fixed cost, and it could change by year. And you just got simply the month that each one of these starts, and that will go to the monthly pro forma accordingly. You can put in the description whatever it is. Uh, then we've got sales. or yeah, sales and marketing expenses. So this could be if you have sales directors, marketing, you might be investing in marketing, and that could change over time. Also, the month of those that starts. I've also added some variable marketing costs, selling in marketing. So if you want to, you're gonna contribute some amount of the total revenue to this, you can uh, demonstrate that here. If that's not the case for your business, you could just put 0% in here and it'll just not show, and that's perfectly fine. Then you've got R&D, so engineers, developers, whatever, what have you. There's 6 slots here. And if you have more, if say you had 10 of these kind of engineers, 5 of these kind, you could also bulk them up and do what their total monthly cost is. So there's just a lot of flexibility for you to work in basically any kind of forecasting assumptions that you've got. And again, you could change the month that each one of these starts. No problem. So the last part of the cost is variable cost of goods sold. Normally with this is going to be either a combination or something like, 50 cents a user for your servers, hosting. You might have credit card processing fees, any kind of other stuff. So there's 2 sections of cost of goods sold. This section here is just a percentage of total revenue, similar to the sales and marketing, how this works. And then if you don't have anything that doesn't make sense for your business, you could zero this out. Then you have this where you put in the actual dollar cost per user, and then that will propagate through. Then finally, the tax rate. So now that we've got basically your revenue and expense assumptions for the next 5 years, there's startup costs. So this could be if there's any initial, things you need to buy, like equipment. Let's say you don't want to rent servers or rent hosting. You want to actually buy all your servers. That could be a cost. You might want to buy intellectual property, licenses, furniture, deposits, all kinds of stuff. So there's 17 slots there to say what that plan is planned to be. These would be costs that happen before the business actually is able to start. Then you've got CapEx, so one-time future costs. It might not all be CapEx, but this is just to show if you plan on having one-time expenditures that are not part of the normal set of operational expenses, and they happen in a given month in the future, you can explain that with this logic, and that also flows to the monthly and annual pro formas and will affect cash flow. Finally, there's a financing tab. You could just standard, principal and interest loan. You could put the loan amount here, the term, interest rate, and the month that you plan on taking that loan out. And then that will automatically, that financing cash flow in and out will show up on the pro formas as well dynamically. All right, so now we've got all these assumptions. So let's look at what it looks like. So if we go to our monthly pro forma here, you can see we've got a free user pool, and based on all those assumptions we just did, you can see it's got a starting monthly users, how much you've added based on your monthly visitors, how much you've added from people who downgraded from paid, how many people left the free pool to go to the paid, and how many people just close their accounts. And then after all that, you've got some kind of end monthly user amount. And to show you some of the assumptions working in action, let's look at the free users added. So you can see it's 750 a month. Let's change and let's see. Let's go actually to year 2. So year 2 is at 1125 a month. Let's say to change that, we would just go over here, year 2 instead of 0.6. Let's say it's double that, so 1.2. Now what does it look like? Well, there you've got 2250. So that just doubled. So you can see those assumptions are all working dynamically and nice and neat. And that goes out for 5 years. You've got then the ad revenue. So the ad revenue is just taking the total um, impressions per user. So you do 750 times whatever that number is, impressions per user, and that's where you get the 937,000. Then the cost or the CPM you're getting, so this is ad revenue from all that, and that equals basically you do 937,000 divided by 1,000. So that's kind of how many units of per 1,000 you have times $1.50, and there's your ad revenue. And you can see this, you know, 36,000 subscribers getting you 55 million views a month at a $1.50 CPM is only 82,000 a month. So it's likely that if you can convert people to paid services, it's going to be more profitable. Now here's the paid pool. So kind of same dynamics. You've got your starting monthly users. You've got the paid users added from the free pool. You've got the paid users added from direct traffic. You've got paid users downgrading to free, and you can see these just equal each other on here. Those that downgraded flow right to there. Then you've got people who just close their accounts, and that works out. 39,000 subs there, and you can see this revenue is basically now this just ties the month or the monthly subscription dollar amount is tied to each of these numbers, and you can just basically convert all these users to actual dollars, and that's what the monthly recurring revenue looks like. And you've got all your churns in there and what's moving around. It's very nice and neat and clean. Then we have our total revenue, so that's just going to take the total revenue from ads plus total revenue from your paid subscription and add it together. So we've got here in this scenario 409,000 a month by the end of the 5th year. Now we have all those expense assumptions coming through. So you can see credit card processing, servers. Let's look at the dollar per user cost. That's an interesting one. So let's say, and this starts in May, let's put it to actually August. And let's say in year 2, it's going to be $3 a user. So let's see what happens there. So servers hosting, year 2, and we started in August. So let's make sure this goes to August. Um, where are we at here? Am I looking at the wrong thing? Yeah, okay. So you can see, just ran a couple tests. So the servers hosting comes in at 791 because if we have the, let's put this date, let's say this is August, and let's say this is 5% of total revenue. So if you go to the monthly, you can see it starts in August. If we changed it to September, you can see their servers and hosting C50. Oh, I have servers and hosting on two different things. That's why I'm getting confused. So the first servers and hosting, which is percentage total revenue, and you might have one or both or none, but if you didn't, you could just you relabel these whatever and put in your what is making sense for your specific situation. So we've got 5% on the first set of cost of goods sold starting in May. And that started in May because our revenue's not starting until then. Yeah, May of 19. That's why it's not coming through until May. So let's put in, I just want you to see this to work. So let's put in December for this one. So you can see, oh, look at that. It's not actually coming in till December. There it is, December, $385, which is doing the 2% times total revenue. You can see total revenue is here times 2%. There's your 385, which is what's populating there. And the month's work, I tested all these cost of goods sold. It's working properly. You can see how if you slated these to start 1 month after each other, they're different. And also I changed the amounts so you can test and see that these are going up as you go down, and they're starting later. And so this test is to prove that. So we've got our cost of goods sold, then we've got our gross profit per month, gross profit percentage. Then we've got fixed monthly costs, which kind of works the same way. All of these is just whatever you put the start month and the amount, it flows into here. Total G&A, S&M, SM as percentage of revenue, R&D. Then you've got our total operating expenses. And now that we have our total revenue and operating expense, we have our EBITDA. So this is kind of how healthy the business is doing. And again, these numbers are all arbitrary. It's just based on what assumptions I've stuck in there. Then we've got debt service. So if you've put any financing in, it'll go into here. You can see if you put this in for the second month at 500,000, starts in month 2, and loan balance will be adjusted by the principal paid. You see the 500,000 comes in the month prior as far as the cash flow is concerned. Then we've got our capex. So you can see this will happen just one time in the future, and per each of these items, and then that flows down through. So now we've got our cash flow. Then we've got some other items. We've got our financing. We've got our startup costs. Then we've got our pre-tax cash flow, cumulative pre-tax cash position. We've got expected depreciation because that's going to be counted when we try to figure out what our taxable income is. We got taxable income, the actual taxes on that, which is checking if taxable income is positive for the given year. If it's not, then it'll be 0. You can see it doesn't actually get positive until year 3, and even though this monthly amount is negative, that's okay. Taxes are fairly difficult, so you're never going to be perfect there. It's just some estimate on what you might be paying in taxes. If it doesn't result, you can, or if you don't want to even see that, you can put in 0% on the expense assumptions for taxes, and or same with depreciation. But I've actually got it there, so if it does apply to you, you can put it in there. Then we have cash flow after taxes and your free cash flow, accumulated cash position. After that, we've got some metrics. So total added users, free and paid is here. Total selling and marketing cost is here. And the reason why we want to know that is because we want to calculate our customer acquisition cost. So we're saying we've spent $11,000 on selling and marketing. We've actually acquired 750 total new users. So the cost per acquisition per customer is $14. Now we've got it. Let me just put in an if error statement here in case you're not acquiring customers until later. So we've got months to pay back CAC. You've got lifetime value to CAC ratio and then lifetime value, all heavily relied upon metrics that show the health of a given SaaS model or recurring revenue model. Or now we're calling this the freemium model. Same kind of underlying concepts. Now, this is the metrics kind of worked out based on my assumptions, but you can see, look at the months to pay back is 7.84. That's a pretty good number. Usually that's what it tends to stick around anyway. Then your LTV is 4. Usually if you're going to go public, you want this to be somewhere around 7 or 8. It means basically what is the lifetime value relative to the cost to acquire a customer. And if you can get that multiple of around 7 is good. But yeah, all these numbers kind of fit with the freemium, and the freemium actually looks like, given holding all else equal, it leads to pretty nice ratios here. And again, but these are just my assumptions I just put in. Yours could be completely different. It just depends. So we've got all of that in the monthly. Then the annual does the same exact thing, but it's just showing on an annual basis all the items I just went over and the cash flow. So that's the entire model. And I think it's super powerful, super flexible. A lot of people could use this in have it benefit them in trying to just explain to potential, whoever, what your forecast might look like given your assumptions. The last thing that we'll look at is then the executive summary and then the visual. So executive summary here is nice. I've got it in a printable format if you wanted to print it. You can go ahead and do that there. It's nice and all ready to go. But you can see it's just got your top line revenues for ads and monthly subscription. It's got your cost of goods sold, your gross profit, profit margin. Then it's got your main high-level expense categories: G&A, sales and marketing, R&D. You've got EBITDA. You've got a percentage of this would be your EBITDA margin. Debt service coverage, which is basically how much EBITDA you're covering to pay your monthly debt service. Then we've got another interesting metric I've built in here is cumulative EBITDA return on equity. So this is what's the cumulative amount of equity returned, or I mean EBITDA made relative to how much equity was required. And so that's an interesting metric. You can see it's actually negative until the last year, but again, this is all based on my assumptions I've entered. Your situation could be completely different. This is honestly just arbitrary numbers. But the cool thing is this logic works. So if you want to set up your specific scenario, it'll be interesting to see what your numbers look like. So cumulative EBITDA ROE, return on equity, this is a new metric I've put in. I haven't put that in other models. Then we've got other cash flow items all nice and neat here. So you've got CapEx, debt service, financing in. This is when you get the loan, financing out. Now this model is going to assume that the last month of the forecast you're going to pay back the debt. It's also assuming that you're going to have an exit valuation here, which is just going to be a multiple of the revenue. And you can define that here. You see if I make that higher, your exit value goes higher, your cash for the last year goes higher. But you can assert that there. And this is the first time I've assumed, at the 5th year, are you able to pay back all your debt if you wanted to? And if you exited the business, theoretically, how much could you get given a given revenue multiple? So exit value, debt balance, so this would be how much you owe, which flows up into here on the last month. Taxes, and then we combine everything down here into free cash flow. So you've got your startup cost here. We've got financing coming in. Now, if we put the financing into the first month, that will flow to match up with your actual startup cost so you can get a real number of your equity needed. Now, this is going to, I also added a free cash flow return on equity. So this is basically saying how much cash has the business generated after taking into account all these expenditures and everything else. What is the return based on your equity requirement? And that's coming down across here. So this is a cumulative number. So this is saying at the 5th year, you've made 98% return on this investment. And since this is a accumulated number, this is already taken into account the initial investment. So this is basically what you have on top of the initial money. So let's say you put all of your own money into this business, 899,000. By the end of the 5th year, you'd be paid back the 899 plus be up 877. Now, that could change based on all these different multiples, but that's what this number means. Right. So we got your annualized IRR, which is going to be slightly different than what the equity requirement is because we're just using this annualized for simplicity's sake. Now, why this 899,000 is bigger than this total, well, it's close, it's 895, is because on an annual basis, this is not tracking how down in the hole you actually went. So this is saying on a monthly basis, you actually were down to 899, 809. Looks like the min there. And a formula will just run this min. But it's saying if you look on a monthly basis, you actually needed to have at least this much equity or else you would have ran out of money. And that's assuming no reserve or anything else. But that's how that number is come up with and how it is relative to the free cash flow is what it looks like. The IRR is going to be close to using this number just because that number shouldn't be that far off from what your negative cash flows are here over time. So I've put that in. Then we've just got our simple annual figures here. So you've got, your average customer acquisition cost for year 1 through 5, months to pay back, average loan to value to CAC ratio. Then we've got net users added per year for the free and paid. That could be some interesting metrics you want to display. And finally, the visuals. So we've got tons of visuals here. 5-year projection just showing revenues, gross profit, EBITDA, free cash flow. You've got disbursement summary. So this shows you where the high level of where all the money's going to and when on a stacked chart. So if you look at the total, that's actually the total expenditures, but it breaks up into each, CapEx, R&D, sales and marketing, all of that. You've got your ratios here, CAC payback in months, LTV ratio. Annual net users added. So this is users per year that you've added for paid versus free, and annual revenue paid versus free. We've got cumulative cash position. So this is looking at the free cash flow over time, and this is looking at the actual monthly cash flow from month to month. Then we've got gross profit and gross profit margin here. You've got cumulative ROE. This is the EBITDA one. And then active users versus paid. Now I haven't, oh, this actually shows EBITDA and free cash flow on the same chart for that. Let's make these a thick outline. So that's the model. And I feel like this is the best recurring revenue model I have built. Really nice. And I'm actually going to charge only $45 fee on this. Now, normally my higher end models like this, I'll charge 75 or 125, but I feel like this is going to have a lot of volume. It applies to a lot of people, so I'm just going to stick the price at 45 and see how it does. So if you want to purchase it, the purchase link will be in the description box below. And that's all I got for you. So smarthelping.com. I'll see you on the next model. This has been a freemium financial model build.